Do you want to know how to grow your small stock account? Join me today as we dive into Warren Buffett's strategy and how he would invest small sums of money to make long-term returns. And if you like this video, definitely drop one of these, as it is much appreciated. So firstly, it's worth discussing Warren Buffett's mentor, Benjamin Graham.
Yeah, if I were working with small sums, I certainly would be much more inclined to look among what you might call classic Graham stocks, very low P's and maybe below working capital, all that. Although, and I would do far better percentage-wise if I were working with small sums.
Benjamin Graham had a different approach to investing, and this is how he would invest in small stocks, and they would have a low price to earnings ratio and valuing them at less than working capital. The premise is here that by buying a company with a low price to earnings ratio, this means that their value of earnings or profits in the company compared to the overall price or the market capitalization. The market capitalization is the number of shares available in total times by the share price. So that's your total value. Then you work out your earnings and see what that multiple is. For example, on average, the American S&P 500, the largest 500 companies in the United States, is about 15 times, and that's a historical average. So when a low PE is mentioned, this typically means less than 5. Basically here, what we're looking for is stocks or shares that have very low premiums on their earnings, basically suggesting that the investors that have bought shares of this stock discount the value of this investment because they don't believe it's worth paying a premium for earnings in the company. This might be because the company is deemed as riskier or might be less sustainable, or it might just be a smaller company without a proven track record, but this is what Warren Buffett would do to encourage growth in a portfolio. However, purely investing on a low price to earnings multiple is inherently risky because more analysis is required. He mentions here that going below working capital and looking at companies that have, valuations less than their working capital. So what does this mean? Well, working capital is current assets minus current liabilities. This is basically a very short-term metric of seeing, is the company able to survive for the next 12 months based on its operations. So it looks at things like cash and compares it to short-term debts and liabilities. Obviously, if a company is valued at less than this amount, but this amount is positive overall, then you'd be looking to get a discount on the company. Effectively here, you're going, I'm buying shares in this stock at a lower price than what the value of their working capital for the next 12 months is, and that's effectively his method and Graham's method of almost risk managing somewhat here. So applying Graham's strategy here involves seeking small stocks with a low price to earnings ratio and valuing them at below their working capital. Warren Buffett typically looks for companies that have low costs, long-term value, and solid business fundamentals when investing small sums of money. The idea here alone is that you've looked here at the price to earnings ratio, you've looked at the working capital and its valuation. Now it's about looking at, is this a company with growing financials? Are they able to grow their top line sales by, let's say, 10% per year? If so, that's fantastic. It means it's a business that is able to grow in this environment. These are key considerations. Another key consideration could be the likes of, does this company have a competitive moat? Now, when Warren Buffett talks about these small sums of money, he does imply that he'd invest in smaller stocks and shares, as we can see in the clips.
An enterprising person can find a lot of different ways of making money. You'll find them, most of them will be in small stocks. If you're working with small money, they'll be in small stocks or in some specialized bond situations. Wouldn't you say that, Charlie?
Sure.
The idea behind this is that he's able to achieve a greater percentage return because he's able to put the time, effort, and energy into researching these smaller companies. And he mentions by going down the stock alphabet and going through every single company there is available. Ultimately, as an investor, it's a very challenging approach to be able to replicate this success because likely if you're looking how to grow a small stock portfolio, it's very likely that you have a full-time job or that you're a very busy individual already. So you don't typically have the spare time to read through 6,000 pages of the current listed companies in X country. So this can be a very challenging approach. And they say here, and Warren Buffett says, how can you identify opportunities in the stock market when working with limited funds?
But the stocks as a group were so cheap that you had to make money out of them. They were Graham type stocks, and that's what I would be doing. I would be combing that sort of a list.
And it's buying thorough research, focusing on undervalued stocks, and being patient for favorable buying opportunities. In one of the clips, Warren Buffett mentions the idea that he was investing in Korean stocks. Now, he mainly did it just as a reminder of his youth and how that's what he used to do when he was younger. He wasn't going to generate a material gain on these investments because, for instance, Berkshire Hathaway is worth hundreds of billions of dollars. Therefore, making these small investments is simply not possible, being the key advantage we have as small investors.
We have relatively few possibilities in the investment world that can make a real difference in our net worth. So you have a huge advantage over me.
A company that is trying to invest £10 million is now going to struggle if a company is smaller than, let's say, £10 million. Maybe you just want a small slice of a company. Well, it's not worth the time and attention of Warren Buffett to look for what the next £100,000 investment is when he's trying to deal with £127 billion of cash on the balance sheet, or dollars, apologies, I'm a UK channel. So the idea here is that as a small investor, we have opportunities as long as we find companies that have liquidity. Liquidity here is the act or the idea that you're able to buy and sell shares in this stock. A stock that doesn't have good liquidity is one that you will struggle to put a buy order through and struggle to get a sell order through. These are inherently risky, and I would definitely avoid these where possible, because it's very important that you should be able to get your capital out in case something changes about the business and you don't want to be trapped and stuck there, for instance. There's an article on CNBC Make It. In 1999, Warren Buffett was asked what you should do to get as rich as him. His advice still applies today. It says here, don't wait to get started. That's the advice that the investing titan shared in 1999 at Berkshire Hathaway's annual shareholder meeting when he asked how to make $30 billion, which was roughly his net worth at the time. The then 68-year-old Buffett, whose fortune has since grown to more than $120 billion, said that compound interest is an investor's best friend and compared building wealth through interest to rolling a snowball down a hill. Start early, Buffett said. I started building this little snowball at the top of a very long hill. The trick to have a very long hill is either starting very young or living to be very old. The Oracle of Omaha said that if he were graduating in college in 1999 with $10,000 to invest, he would be strategic about choosing where to put his money. I would probably focus on smaller companies because I would be working with smaller sums and there's more chance that something is overlooked in that arena, Buffett explained, saying he would start examining companies alphabetically and work his way through there. The idea here is that not many institutions are able to put their time and attention into these small companies. Therefore, an investor of a small size has an inherent advantage. You could research in depth a company with a market capitalization or total value based on the stock market of less than £5 million. Most institutions can't do that because it's just not a sustainable return for the overall value of their shareholder funds, so it's just not worth it. So Buffett suggests that investors need to fend for themselves and rely on their own knowledge and intuition when searching for promising businesses to invest in. He added that savvy investors would do best to learn what you know and what you don't, and act very vigorously when they see something to be considered as a good opportunity. You can't look around for people to agree with you. Buffett said of putting money into an investment, you can't look around for people to even know what you're talking about. That said, and this is where we go on to the contrary part of this, not many small investors are going to be successful in this approach because they don't have the same time, effort, or energy that, let's say, Warren Buffett could have in that situation. Myself or you watching this video, you might go, well, I just want to know how to invest a small portfolio and get started. I don't know what price to earnings ratios are. I don't know how to look at beyond working capital. And I'm sure as hell don't know if I'm going to invest in a small company that I've never heard of before. So Warren Buffett is also a staunch supporter of index funds, which hold every stock in an index, making them automatically diversified. To build wealth, investors should consistently buy an S&P 500 low-cost index fund. That's what Buffett said in 2017. Keep buying it through thick and thin, and especially through thin. The premise here is called dollar cost averaging. The idea that as frequently as you're paid, you invest a portion of your income immediately into stocks and shares. And if you do that on a frequent enough basis, you can build up a small stock portfolio over time. The S&P 500 in particular has quite a few advantages. The fact that it's diversified, the fact that a majority of the index funds you buy of the S&P 500 are typically low fee because there is is no investment manager trying to manage this for you. And again, it mitigates that risk of looking at these very small companies that are very specialized, because you might not know what to look for. So understanding what you know and what you don't, as Warren Buffett said here, is key. If you understand that you don't know this much about investing, you'd like to learn more, well, a good step is to go, okay, I'd like to learn more, I'll do the research. In the meantime, I'll invest in a broad-based index fund, one that tracks the global stock market, some of the most successful companies in the world. At least I know I've got a secure base for my investments, and then maybe I could do a core and explore strategy where I'm looking at the idea of going, okay, 90% of my portfolio is invested in this index fund. With 10% of my money, I'm going to experiment. I'm going to understand and try and look maybe at some of these companies. But ultimately, it's a very risky approach in my mind. I think you've really got to have the thorough in-depth analysis and a good background of financial accounting to really win or get ahead in this market. After all, 80% of investors fail to outperform the S&P 500 benchmark. So if you can't beat it, simply just buy shares of that index fund. But how can beginners leverage Buffett's investment principles to grow their small stock accounts effectively? Well, Buffett's principles that he takes into account for his larger portfolio size, aka with Berkshire Hathaway, could be used. And if an investor is potentially disciplined and they focus on long-term value, businesses that have durable competitive advantages, a business that might be able to, sell a good at a lower price and still make a good profit margin because they have something called economies of scale, basically meaning that as they've grown inside, the cost of getting these goods is now less because they can negotiate more favorable terms with, let's say, a supplier, and therefore they can sell at a lower cost, attracting more consumers. This makes it very challenging for any new businesses to compete with this because they're not going to get access to that low cost base. And then by doing that, taking the approach of dollar cost averaging, you could gradually build a small stock account over time, like what I've done on my channel in my playlist, My Stock Portfolio. If you're interested in that, definitely go check that out and subscribe for more investing content. Have a fantastic day.